Welcome to Taking Stock for the week ending the 8th of October 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share markets. Well, last week we alluded to some of the emerging themes that has weighed on the market sentiment in recent times, and this included the potential collapse of Chinese developer Evergrande, as well as inflationary fears from supply chain constraints. Also, the uncertainty on whether the US will raise its debt ceiling, although a deal has been reached to extend the ceiling until early December. With rising inflation, there are now fears of stagflation, a term used to describe a period of weak economic growth with high inflation. Often during this period, very few asset classes perform well, but the best way to hedge against stagflation is to invest in quality growth stocks with high profit margins to cushion the inflationary pressures. These companies tend to be price makers and can also grow irrespective of the market environment. For example, some of our star stocks in this group include Fisher & Paykel, ResMed, CSL, Cochlear, and Pro Medicus. Others that have very strong market positions include REA Group, Netwealth, and Codan. Consumer staple stocks like Woolworths and Coles could also provide that defensive element to your portfolio. Also, investing in inflation drivers like commodities and energy-related stocks can help as well. And gold also tends to do well because it acts as an inflation hedge.
Yeah, meanwhile, central banks around the world are planning to taper their bond purchases. In other words, reduce the level of money printing that has assisted the flow of credit markets and helped the economic recovery. Along with inflationary pressures, this has led to rising bond yields, which represents future expectations of interest rates. In fact, the Reserve Bank of New Zealand has lifted interest rates from 0.25% to 0.5%, and this has led to questions around whether the Reserve Bank of Australia will need to raise rates before 2024. In the US, Fed officials have signalled at least 3 interest rate rises by this time, as specified on the chart on screen that shows interest rate expectations that are indicated by the orange columns.
Yeah, but should we be concerned, Jake? Rising rates tend to correspond to higher economic growth. Also, rising energy prices on the back of supply bottlenecks are expected to be transitory as vaccine rollouts continue and economies begin to open further. Meanwhile, although global economic growth is expected to slow from last year, forward growth remains above its historical average, as can be seen on the chart. Australia has yet to fully recover from lockdowns, and when the states open up again, then we should see a tailwind to economic growth.
Yeah, hence investors should not fear this market correction, but should embrace it. Use it to look for star stock opportunities, especially as we continue to initiate on stocks and transition towards our optimized quant strategy. For those who are still concerned with stagflation, look for companies with strong growth businesses and high profit margins, and potentially consider some gold stocks as that inflationary hedge.
So now let's turn our attention to some of our star stock highlights this week. We reinitiated coverage on Altium as a star growth stock following a recovery in its quality and growth factors like return on equity moving back above 15% and net profit margins also rising to 19%. The company makes software for engineers to design printed circuit boards and has recently knocked back a takeover bid from US engineering giant Autodesk at $38.50 per share.
Yeah, last year COVID hit the company hard, with sales declining as projects for new client products dried up or were deferred, leading to an 18-month earnings downgrade cycle. However, earnings growth is expected to recover circa 41% this year on the back of rising demand for electronic manufacturers, the rollout into China, and a continuation of its transition strategy towards a cloud-based platform.
So to put things into perspective now, Altium wants to be the central hub of the design to manufacturing process and plans to connect manufacturers, suppliers, and designers, basically all aspects of the engineering process via the cloud. Hence, the biggest growth driver for the business going forward is how the company is transitioning from a desktop program to a central hub on the cloud. And this is enticing customers to make that switch.
Another initiation this week is Broadline star growth stock MAAS Group, MGH. The company is an Australian construction equipment and service provider with diversified exposure across civil, infrastructure, mining and real estate. end markets. About 60% of the group's revenue is tied to the government's FY22 infrastructure budget, which makes earnings more defensive than other companies within the sector. Earnings are expected to grow significantly this year in excess of 50%, driven by an expanding pipeline of infrastructure works, such as inland rail from Narrabee to North Star in New South Wales and residential construction pipeline in Dubbo, New South Wales, although analyst coverage on the stock remains slim.
Yeah, but positively, the founder, Wesley MAAS, he retains a 68% stake in the business, meaning there is a strong alignment of interest between management and investors.
That's right, Kien. And turning our attention to the week ahead, no star stocks will be reporting next week. However, several star stocks such as Commonwealth Bank, Telstra, CSL and ARB Corp will be hosting their AGMs. And for the trend-sensitive investors, we've had a series of bearish SD-Max signals coming from Breville Group, BlueScope Steel, Brambles, Coles and Perseus Mining, and no changes were observed on the SD30 TSR.
We have a pretty exciting star growth stock for under the microscope this week. The company is called Objective Corporation and develops software used mainly by governments to manage information and process developmental application plans. Despite a market cap of 1.8 billion following the strong share price appreciation, it's not covered by any analysts. And although this means some earnings uncertainty, this also represents an opportunity for us to highlight the company that has not come on the radar of many brokers.
That's right, Kien. The company has demonstrated an improved trend in return on equity and net profit margins. Furthermore, the company does not capitalise on research and development or R&D expenditures, which does help it to achieve a strong earnings quality rating. Despite no outlook showing on Stock Doctor, management did state that they expect a material lift in revenue and profitability in FY22.
And investors may be concerned with its valuation multiple trading at 114, roughly 114 times FY21 PE levels. However, these multiples are consistent across other high growth companies like Xero, for instance, Pro Medicus, and rapid growth can drive these valuation multiples down quite quickly. But those who are uncomfortable with buying into the current share price may want to wait for a period of price consolidation, especially given that the stock has rallied over 50% in 6 months.
Yeah, and the attractive aspect of Objective Corporation is the company's founder, Tony Walls, remains heavily involved and retains a significant holding of 66% of shares on issue. Furthermore, the Objective Corporation's management team holds 75% of total shares, reflecting adequate skin in the game.
We are currently transitioning our portfolio towards an optimized star growth stock model. And a few of our members have been worried, particularly with our star stock transitions from star growth stock to borderline star growth stock. So a useful question this week is, what is the difference between a star growth stock and a borderline star growth stock under our optimized quant model? To understand this, let's take a look at this flow chart. Under this model, both star growth stocks and borderline star growth stocks need to be financially healthy and have sufficient liquidity. This hasn't changed from our original model. But now both star growth stocks and borderline star growth stocks also need to meet our stringent quality and growth thresholds under Golden Rule 2, depending on its industry. Previously, borderline star growth stocks may only need to satisfy Golden Rule 1, financial health, and Golden Rule 3, outlook and active risks.
Yes, and then a qualitative overlay is then applied to the opportunity set to weed out poor quality companies that may have passed the Golden Rule 2 criteria due to abnormal circumstances. This qualitative review includes an assessment of their active risks and earnings revisions. Finally, about 30 star growth stocks from this opportunity set are selected using a Z-score ranking algorithm based on their past financial performance metrics. The ranking process allows us to keep the star growth stock portfolio consistent at around 30 stocks. The borderline star growth stocks are then those that lie outside of this ranking process but remain within our group of high quality growth companies.
An important point to note, though, is that a transition from star growth stocks to borderline star growth stock does not mean that the fundamentals of the business has deteriorated. In fact, Many of the stocks that are in our Broadline Star Growth stock portfolio are high quality businesses. These include stocks like Breville Group, Credit Corp, ResMed and CSL. Remember, Broadline Star Growth stocks now need to meet our stringent quality and growth thresholds under Golden Rule 2 before they could be included. And this was not the case with our previous model.
Note that a highly ranked star growth stock does not mean it is better quality than the one ranked below it. The reason for this is because the ranking system only uses past financial performance to rank the stocks. Other factors, including active risks and earnings revision, should be part of the stock selection process and is included in our qualitative assessment. Those who want more details can go to our latest stockroom recording where we provided a comparison of our optimized process with our previous stock selection process.
Yeah, thanks, Jake, again for your valuable insights today.
Thanks for having me on again, Kien.
So we should be finalising our transition to our optimised star growth stock model by the end of next week. Until then, you can keep on top of these updates using the recent updates tab on Stock Doctor. And of course, take advantage of the star stock initiations to look for opportunities during this market correction. In the meantime, take care and have a happy, healthy and prosperous week, everyone.